I'm Tim Coughlin, a Managing Director at Edgemoor Investment Advisors. Welcome to our 16th Annual Investment Forum. Some nice things have happened since our last forum a year ago. How about those Washington Nationals, the Mystics, the stock market? And it's been a good year for Edgemoor and our clients as well. This is a milestone year for Edgemoor. It is our 20th anniversary. In December 1999, we opened for business and have grown our assets under management over the last 20 years to more than $1 billion from our friends, referrals, and strong markets we have enjoyed. While our investments have been growing throughout the years, our management of them remains the same as when we first started, and that's what we will be talking about. Tom Meehan, our president and founder, Paul Meehan, Jordan Smythe, and Gay Truscott will also be making presentations. We will explain our approach to investing, discuss current and stock and bond market conditions, review some investments we are currently buying, and discuss financial planning. At Edgemoor, we are fundamentally buy and hold investors in equity and income investments, which we will believe will perform well in the long run. On average, we own our investments for about 5 years, and some of them much longer. We are not market timers because it is impossible to know when the markets will go up and when they will go down. What we do know is that in the future, just as in the past, there will continue to be both bull markets and bear markets. When bear markets come, it is especially important to stay invested. Don't sell good investments at depressed prices. Our approach to investing begins first and foremost with asset allocation, by which we mean the percentages of funds to be allocated to equity investments and to income investments. This slide shows the annual compounded rates of return for U.S. stocks versus the 10-year U.S. Treasury bond since 1946. The average annual return of the stock market has been about twice the annual return of the 10-year Treasury bond. Over time, the impact of higher annual compounded rates of return for stocks than bonds is truly amazing. This next slide shows the growth of $1,000 invested in the stock market versus $1,000 invested in the 10-year Treasury bond for the same period from 1946 through 2018. $1,000 invested in the stock market in 1946 grew to $1,380,000 in 2018, compared to the same $1,000 invested in the 10-year Treasury bond, which grew to only $45,000. No wonder higher compounded rates of return have sometimes been referred to as the eighth wonder of the world. Stocks have experienced much better returns than bonds, but they are volatile. Stock portfolios lose 20% or more of their value in bear markets. And while the stock market historically comes back from downturns stronger than ever, the time it takes to do so can be excruciating. Stock market volatility is what causes so much concern and angst to investors. But if you have a long-term investment horizon, exposure to stocks can give you wonderful returns over time. Income investments are typically safer, less volatile, and have higher yields than equity investments. They add stability to portfolios. The majority of our clients want and need balanced portfolios with both the high long-term returns of equity investments and the stability of high interest and dividend yielding income investments. At Edgemoor, we have very specific views about the types of equity investments and income investments we choose. For equity investments, we avoid highly speculative stocks of companies which have little or no earnings, like Tesla and Uber. We like stocks with steady, reliable earnings. For income investments, we are still wary of long-term bonds because their interest yields remain so low. Not only do bonds offer very little interest income, but their prices will be vulnerable when interest rates rise. For example, the 10-year Treasury bond today is yielding only 1.8%. And if its current interest rate were to rise 1%, the current 10-year Treasury bond would lose 9% of its value in the marketplace. So in addition to bonds, we include a variety of other types of higher-yielding investments. We believe our investment approach has served us well, including this year through October, when the returns after fees of our balanced portfolios have exceeded their market benchmarks. In our opinion, investors should be comfortable with their asset allocations and be able to sleep at night. A general rule of thumb for those at retirement age is 60% in equity investments and 40% in income investments. More in equity investments for younger investors with longer investment time horizons. Depending upon circumstances, some investors, because of other income investments such as real estate, may choose all equity investments. And some investors with low risk tolerance may choose all income investments. It's an individual decision and not one size fits all. Most important is that the individual understand the return and risk differences between equity and income investments and choose the asset allocation with which they are most comfortable and is best for them. This is something we can help you with. Asset allocation needs to be carefully reviewed and understood with your investment advisor. And asset allocation needs to be customized to the individual investor's needs. Now it is my pleasure to introduce Tom Meehan, who will tell us about the stock market and how Edgemoor chooses equity investments.